Okay. Yeah. So I think the link are available in all our group now. So no, I was on mute before, so I was trying to generate the YouTube link for those that will not be able to join the class. So let's start. Please confirm if you can see my screen. Why don't we share the screen now? Please confirm if you can see it. Okay. So, welcome once again. Sorry, we are starting almost late again. Should have started by 9. The class should be end by 10. But tonight we'll be a bit faster about it. So, IAS 8, accounting policy, changing accounting estimate and errors. So, let's start with accounting policy. First, what is the meaning of policy? So, you can say policy can be simply defined as laws, principle, basis, rules, or guideline that is being used for a specific purpose. So when we talk about accounting policy, so accounting policy has specific principle, basis, convention, rules, and practice adopted by entity in preparing and presenting its financial statement. So basically, these are principles that a particular organization decided to adopt from the available options, from the available principle, from the available guidelines. So it's a selected principle that a particular organization decided to be using in preparing their accounting basis. So there are some key definitions that I'll try to understand here. This material is actually from one of our my lecturer. So let's try to add one or two things to it. So let's start from the accounting policy itself. So these are specific principles, convention, rules, and practice adopted by an entity in preparing and presenting its financial statements. So when we talk about policy, a set of principles, accounting policy, a set of principles related to accounting, a set of rules, a set of decisions related to accounting that an organization decided to opt in for in between those available options. So we have a clear example of what we mean by policy, accounting policy here. And one of the clear examples is what we use to value our inventory, method of valuation of inventory. We have FIFO, we have LIFO, we have weighted average cost method. So all these are different examples of accounting policy. Now, a particular organization may decide in line with the standard, okay, what do I want to use to value my own inventory? Okay, I'm going to use first in, first out, or weighted average cost. So either of these two that the organization decided to opt in for, that is the accounting policy of that particular organization when it's relating to inventory valuation. One of the basis there is that as an organization, you can't say that, okay, this year I'll use FIFO, next year I'll use weighted average cost. No, you need to be specific with whichever one you are going to pick. And once you pick it, there should be consistency in the application of that particular policy. It should be consistent with the application of the policy that you decided on. Should not be, okay, today I'm going to choose this, next one I'm going to choose this. No, you should be consistent with whichever you are going to pick for your operation. You should be consistent with it. And the purpose of changing, the purpose of adoption of this particular policy should not be as a result of the decision of the management of organization to pick the most suitable policy or the most advantageous policy that is going to make the financial statement of the organization look more enticing to the general public. The main purpose of choosing a particular accounting policy should be either to improve the presentation of financial statement to ensure true and fair view presentation to the stakeholder that will be making use of that particular accounting information. It should be the purpose of creating more clarity around the basis of operation of the organization, not as a result of the organization trying to pick that particular policy because it's going to suit their own personal gain. That should not be the reason why an organization is adopting a particular policy. Let's move on. We have retrospective application. What do we mean by retrospective application? Retrospective application is the application of accounting policy to a particular transaction or to a particular transaction and event of a period before the accounting policy was made, as if it was that as if that policy had always been applied. Let me try and explain this. What do we mean by retrospective? Retrospective is backward application, backward representation, backward or previous application of accounting policy that was just being formulated now. We just formulate that accounting policy today. But retrospective application simply means that you are going to apply that accounting policy that you formulated today right from your previous day transactions. You are going to reapply it to your previous day transaction, to your previous week transaction, to your previous month transaction, even to your previous year transaction. So retrospective application is the backward application of the present form or of a recently formulated accounting policy to the organization operation. So you are going to apply that particular, maybe the organization just decided that they will be using FIFO to value their inventory today or this month. Now, retrospective application simply means that the organization will now go back to previous months, which is July, June, May, April, March, February, January, using that particular FIVO that was just being selected today to represent their inventory. That is retrospective application. So also we have prospective application. It's just an opposite to retrospective. Prospective application is just the application of an accounting policy starting from that day that you been decided on, it's been formulated. You are going to apply that accounting policy going forward, not backward. You are going to start applying it going forward. We talk about retrospective as backward application, while prospective is on that present day, then going forward from that day. Then we have prior period, that is previous period. You have prior period errors. So we are still on that policy. We are still going to look at estimate and error. So errors is a mistake. Error is a mistake. And the close by terms of error is fraud. So the difference between fraud and error, one is deliberate mistake, the other one is not deliberate. When it's an error, that means that the mistake is not deliberate. But when it's a deliberate mistake being made by a particular body or by a particular personnel with a purpose of enriching themselves with financial gain, that particular mistake becomes a fraud. Still going to get to that. And we have accounting estimates and appropriation in financial statement of an amount to be recognized for which there is no precise means of measurement. So it's just based on company policy. So you just decided that, okay, please, the estimate we are using for this particular transaction is the estimate we are going to use for this particular provision. By making a provision, the organization can decide that, okay, in our own organization, we are going to make use of our previous month bill to make provision for this recent month and subsequent month bill. There should be consistency in your decision. Then, impracticable, this simply means impossible. The retrospective restatement is just the same thing with what I've explained. This is the correction of recognition, measurement, and disclosure of amount in financial statement of previous period, presented as a result of retrospective application of new accounting policy and correction of prior period. Now, let's look at different examples of accounting policy. We have the method of valuing inventory. We have method of valuing inventory. Method of valuing PPE. IAS 16, other IAS 16, you can either use the cost model or evaluation model. So whichever you are going to adopt it, you can pick it out of these two. The moment you decided to opt in for either of these two, that means you have an accounting policy you are using in your organization. You also have method of measuring intangible assets, whether cost model or fair value model. Intangible asset, that is IAS, that 30, is that 38 or 37? We have decision on presentation of depreciation in the profit or loss. We have classification, presentation, and measurement of assets and liability. We also have valuation of IFRS 9, financial instruments. You can either use fair value through profit or loss or through OCI. It's also a change in accounting policy. Now, let's look at this. In line with IAS 1, consistency of accounting policy. Just I've explained about this before, but let's look at it again. In line with IAS 1, presentation of financial statement require the entity to select accounting policy consistently from period to period on similar transaction, events, and condition. That is, frequent changing in accounting policy is not permitted. You can't just wake up that, okay, today, because you notice that using first in, first out valuation of inventory is not making your P&L statement to be a profitable one. You now decide that, okay, no, we are going to use average cost method. No, you can't do that. There must be a reason for changes, and we are still going to get to one of the conditions that can make an organization to change their accounting policy. One of the conditions that can warrant changing of accounting policy. Okay, someone said it's tiny. Okay, sorry. I'm going to work on that. Sorry about that. Sorry. So I hope it's clear a bit now. Hold on. Sorry. I hope is big a bit for us to see now. Can you confirm if it's bold a bit now? All right. Thank you very much. Thank you very much. So there must be consistency in the application of what we what policy the organization is going to adopt. You can't just say that okay, you adopt this one today, I want to change it tomorrow. It's not possible. You can't do it that way. We also have changes in accounting policy. In line with IAS 1, presentation of financial statement require an entity to select accounting policy consistently from period to period or similar transaction in faith and condition. Okay, so however, ISS require that entity can change accounting policy if it's as a result of the following. If it's as a result of the following. Number one is changing. The change is required by IFRS. That is a mandatory changes. Just like we have IS 18 to 15, we also have another one coming up now, IS 1 to IFRS 18, which now give us a new interface, a new way of presenting our statement of profit or presenting of our statement of profit or loss. So that is a mandatory change. It's not mandatory yet, as at the period is not yet arrived, but early adoption is also allowed. But the moment that particular period of adoption is arrived, then it's become a mandatory that every organization will abide with. Second one is the changing will result in more appropriate presentation of event or transaction in financial statement. That is voluntary presentation, changing from cost model to fair value model of an investment property. So this is what I'm saying, that yes, changes is allowed. However, the purpose of that changes must be so clear that you see the changes that will result in more appropriate presentation of event or transaction in the financial statement. So you see this criteria, it has been tested over time. People have been asked, and some of the questions that is it, I've asked people about what are the criteria, what are the conditions that can make an organization to change their accounting policy. Number one is when there is new legislation or government policy. When there is government policy that say, okay, you stop doing this and you start doing it that way. So then that changes must occur. A new accounting standard, we set an example of IFRS 18 replacing IAS 1. Changing the way in which an item is presented in the account, fair presentation, just to ensure that there is transparency and fair presentation. And when a subsidiary has a different policy to that of a parent, the subsidiary is allowed to change. So this is a group account store. When a parent company is taking over a subsidiary, the subsidiary can decide to adopt the policy of the parent company. Determine when there is a changes in accounting policy. Changes in accounting policy can be established as follows. The accounting policy chosen by an entity should reflect transaction and events through recognition, measurement, and presentation. Recognition, measurement, and presentation. That means where there's a changes that occur, how should that changes be presented? How should that changes take effect in the operation of a particular company? So the changes can come in form of recognition, that is capitalizing or writing of a certain type of expenditure. Like we have interest expense. There are some interest expense that we can capitalize, like borrowing costs. So the recognition is that an example of that is a situation whereby organization have been, expensing the interest costs incurred on a qualifying capital expenditure, but now they are now trying to capitalize it. They are trying to add it to the value of their assets. So that is in form of recognition. The measurement of the current asset at cost or at valuation. The presentation, classification of cost as cost of sales or administrative expense. That is basis. There are some kind of costs that organization, depending on the industry of the organization. If you look at some organization profit or loss, you will see their administrative expense and their depreciation is part of their cost of sales. Some will add it to the administrative expense. Some will even divide it that okay, this percentage goes to cost of sales, this percentage go to administrative expense. So these are the example of presentation of changes in accounting policy. Accounting treatment for changes in accounting policy. When changes is required by the IFRS in line with IAS 8, an entity is expected to account for the changes in line with the transitional provision of specific IFRS. However, when there are no transitional provision in the specific IFRS, then the changes should be applied retrospectively. When it is impracticable to apply retrospectively, then it should be applied prospectively. What are they trying to say here? You have looked at the definition of some key terms when we start the topic. You have impracticable, you have prospective, we have retrospective. What are they saying here? What they are saying here is that if the changes that occur in the accounting policy of organization is as a result of IFRS requirement, it's a mandatory requirement, just like we have IAS 1 to IFRS 18. If the changes that occur is as a result of IFRS requirement, the changes, the treatment of these changes should be in line with the transitional provision of the accounting standard. What do you mean by transitional provision? Like, what is the context of that particular accounting standard we are trying to adopt? The new accounting standard we are trying to adopt. What are the requirements? What is the provision we have on it? What is the provision we have under that particular accounting standard that we want to adopt? So if you have provision that tell us how to apply the changes, then we should consider that as our number one solution. But in a situation whereby there is no provision, although the changes is being required by the IFRS, but however, there is no clear provision to how to treat it, then the changes should be treated retrospectively, that is backward treatment. From the day that we decided to adopt to that new policy, we should also present our previous statement using that same policy. However, in a situation whereby it's become impracticable, that it's become impossible for us to represent our previous transaction using that new policy, if it's impossible for us to repair our previous transaction using that new policy, then we should adopt prospective and the presentation of the policy. You should adopt prospective presentation of the policy. Okay, you are saying my mic is low. Sorry about that. Sorry, please. Can you confirm if I'm audible enough now? Can you confirm, please? Just use your reaction. Okay, thank you very much. Thank you. So, I have accounting treatment for voluntary changes. That is when the organization decided to do it voluntarily. It's not being required by the IFRS. It was just the willingness of the organization to change their accounting policy. However, the reason behind their willing and able to change their accounting policy should never be the purpose of them trying to have a personal financial gain from that presentation, but rather it should be to ensure fair and utmost good faith presentation of their financial activities to their stakeholder. If the changes in accounting policy is being done voluntarily, the treatment can be retrospective application, that is the application of the policy to a transaction and events of period before the policy was made, as if that policy had always been applied. Prospective application is the application of new accounting policy to transaction and events occurring from the period when the policy was made, then going forward. That is all about accounting policy. Now let's look at accounting estimate. An accounting estimate is made for an item in financial statement where the item cannot be measured with precision and there is some uncertainty about it. An estimate is therefore based to some extent on management judgment. So basically what we have is an estimate is just, what is the best word to use to define this? An estimate is just basically an assumption with some clear guideline and principle, an assumption of the organization. Example of estimate, we have provision for bad debt, we have inventory. There is no specific line of the standard that say that, okay, organization A, your provision for bad debt should be 1,000 naira. However, based on organization decision, their management decision, they have a clear view of, okay, what is the worth of our receivables? What is the how old are those receivables? How old are those receivables? So for what time have they been receivable? Since when have we made those sales? So what are the chances of us be able to record all those receivables? So these are the age analysis. Yes, age analysis of our receivables. What is the age analysis of our receivables? So you see from there, okay, this receivable fall under 30 days, 60 days, 90 days, 120 days, 150 days, 180 days, 210, and so on and so forth. That we should know that for receivables that have been in our book close to 1,000 days, it's very high. There's high likelihood of that receivable being a bad debt. So if you want to make provision for a bad debt, these are the likely guidelines that organization will use in determining their provision. We also have inventory obsolete. You have fair value of financial assets or liability. If you can remember, we choose our fair value IFRS 13 not too long, and there are some criteria that organization can use in determining their fair value. Although there is no specific value to that fair value determination, but however, there are some criteria using the using the market one. If there is a close asset of the same class, using that value to determine your asset value too. You can use the asset of the same class that its own value is being known. You can use it to determine your own value, your own asset value too. If I'm using a Toyota Camry 2008, if I see other cars that belong to the same class with that Toyota Camry, maybe under of the same year, of the same durability, of the same comfortability, I can likely use that price to determine my own car too. So that is, and these are the examples. The useful life of a non-current asset. The useful life of a non-current asset too. The most appropriate depreciation pattern is also an example of estimate. Measurement of warranty provision is also an example of estimate. So here we have change in accounting estimates. Please 1 second. Let me quickly flip for. Sorry. So a change in accounting estimate is a revision to the previous estimate as a result of new events, change in condition, or additional relevant information. Change in accounting estimate are expected on regular basis, that is at least annually, except if the condition or circumstance that existed as at last estimate had not changed. So basically what they're trying to let us know here is that changes in accounting estimate is expected to take place at least yearly as a result of a feasible or a likelihood of changes in condition of assets, changes in condition of liability for provision, changing in condition that we can see, what is the present condition of this particular asset as at this year, and determine their useful life. If we say an asset is going to use all, it's going to be used for 5 years, and at the end of the 4th year, the asset still look like a very new asset, and there is not so much wear and tears, which shows that in the next 1 year, this asset can be written off. So if this is the case, it's so clear that the asset is so much in good condition that we can still use it for more than a year, which is the remaining useful life we have in our book. If this is the situation, then the estimate useful life of that particular asset can be revisit. So the estimated life can be readjusted and reviewed. So, example of changes in accounting estimates: you have changes in existing provision, a change in depreciation rate, a change in percentage of allowance receivable, a change in method of depreciation. So, one thing we should be very careful here is that we should never mistake change in estimate to change in policy. When you are changing an estimate, is different from when you are changing a policy. That is why you need to be very careful with the meaning of estimate and policy. With that, you should be able to determine their examples. When you are changing the method of depreciation, like straight line to reducing balancing, that is changing in accounting policy. You are changing the policy. You are changing your valuation policy. But when we are talking about changes in useful life, that is not changes in policy. That is changing estimate. Please, we need to be very careful with this. You are using straight line method, you change to reducing balancing method, that is changing policy. You also that 5 years before, now with that 10 years, that is changing estimate. Moving forward. Treatment of change in accounting estimate. According to IAS 8, accounting estimate should be applied prospectively. That is, financial effect of the changes should be considered in the correct period. So when you're talking about changing the accounting estimate, it's make use of prospective application. It makes use of prospective application. That is, you start the application of that changes right from that day that you make the estimate going forward. You're not going to go back and start saying, okay, previous does not make sense. It's not even irrational. It's not feasible. When you change the useful life of your asset from 4 to 5 years that you have before to 10 years, where the asset is at the last year of that is at it's 50 years already. So it's not something you'll now go back to year one and start changing that because the asset is supposed to use 10 years. No, you can't do that. So changes in estimates should be prospective application. The event of change in accounting estimate should be recognized prospectively, but including it in profits or loss for the period in which changes is made, if the changes affect that period only. In the profit or loss for the period of changes are future period if the changes affect both. To the extent that the changes in estimate result in changes in asset and liability, it should be recognized by adjusting the carrying amount of the affected asset or liability in the period. So if the period you are preparing your financial statement, you have adjusted the useful life, you have adjusted your provision for bad debt or provision for the provision of bad debt. So that changes. If it affects the period under review, then it should, the changes should include so the effect of that changes should be recognized in that period that is going to affect. Prior period error. Prior period error are omission or misstatement in an entity financial statement for one or more prior period arising from failure to use or misuse of reliable information. So these are examples of error. We have mathematical mistake, we have mistake in applying accounting policy, We have oversight and misinterpretation of facts, and we also have fraud. There's a thin line between fraud and error. The moment that mistake become a deliberate, it's no more an error, it's what is a fraud. So correction of prior period error. According to IAS 8, financial effects of correction of prior period error should be adjusted retrospectively. You should go back and correct that previous error that you made. You should go back and correct it. If it is material, you should go back and correct it. While correction of prior period error relating to period not presented in the annual report should be adjusted retrospectively through opening retained earnings, unless it is impracticable, that this is possible, it is impossible. So what they are saying here is that maybe you have prepared the previous year financial statement, they have audited, and it has passed, pass through the necessary presentation. However, now we want to prepare, we now realize that mistake. We are going to have retained any from that previous period. So the mistake that we made from that previous accounting year that we prepared, we should take effect, we should take a recognition of that mistake by using it to adjust the previous year retained earning. That is, the retained earning brought forward to this current year should be adjusted, should be corrected. If it involves overstating of value, we should be able to reduce that retained earning. If it involves understating of value, we should be able to increase that the value of that current year and the retained earning brought forward. So I think that is the end. The remaining one is just question, and thank God some of these questions they have solution in it. And here I have some past questions. See, all these questions that they have, they are marked. They are past questions. They are past questions. They have the solution here. Wow. So I have the solution here. I need to go to the solution. Well, no problem. It's fine. I have solutions here. So let's just look at one question together. I'm going to look at this first question. I don't want us to waste most of my time this time. I'm going to read this first question now, and we are going to look at the solution. Then I will allow anyone that have question to ask. I will allow anyone that has question to ask. I don't want us to spend much time tonight. We have been wasting time. So the first question is said. So these are likely past questions. The Chief Financial Officer, CFO of Nigeria BOS Limited. The Chief Financial Officer of Nigeria BOS PLC, a company listed on the Nigeria Stock Exchange, recently attended IFRS certification training of Corporate Finance Faculty of the Institute of Chartered Accountants of Nigeria. He realized that due to the complexity of international financial reporting standard, judgment used at signs of transition to IFRS may result in prior year adjustments and changes in estimate disclosed in financial statements. He also understood from the industry section on IAS 8, accounting policy, change in accounting estimate and error, that selection of accounting policy and estimate techniques is intended to aid comparability and consistency in financial statements. Among other things, IFRS also places particular emphasis on the need to take into account qualitative characteristics and the use of professional judgment when preparing financial statements. The IFRS may appear prescriptive, and the achievement of all the objectives for a set of financial statements will rely on the skills of the preparers. When selecting or changing accounting policy, changing the estimation techniques, and correcting error, entities should follow the requirement of IAS 8. However, the application of IAS 8 is usually often dependent upon the application of materiality analysis to identify issues and guide reporting. Entity also consider the acceptability of the use of insight in their reporting. With the above knowledge, Sorry. With the above knowledge, the CFO of the Nigeria Bureaus is still not clear about the circumstances under which Nigeria Bureaus can change its accounting policy, conscious that IAS emphasizes consistency in the application of the accounting policies once chosen. Required. Advise the CFO on the circumstances where an entity may change its accounting policy, setting out how a changes in accounting policy is applied and the difficulties faced by entity when changes in the accounting policy is made. This is also a past question. And I just explained to us now that one of the key areas that they normally ask is those 4 or 5 conditions. B, discuss why the current treatment of prior error could lead to any management by companies together with any further argument against the current treatment. So if you look at it here, these are the circumstances. International accounting standard. If you want to answer a question, you need to make it more presentable. ICAM marking scheme is not that generous. So if you saw a question and there is 5 or 10 marks, 5 marks we attached to, let me even use 5 marks. You should be able to write a reasonable solution. This is not, it is a financial reporting. So your answer will also be in form of writing a reporting. When you are trying to provide answer to a particular question, you should make it look presentable, like you are presenting a reporting. This is not an undergraduate solution that we just go in the right solution and just start listing or start divining. You should be able to provide a storytelling mode of answering questions. Your storytelling should not be much. It should be very meaningful and speak directly to the question being asked. Look at this. International Accounting Standard, IAS 8, accounting policies, change in accounting estimates and error, prescribe the criteria for selecting and changes of accounting policy, accounting for changes in estimates and reflecting correction of prior error. Changes in accounting estimates and corrections of error are generally accounted for retrospectively, unless this is impracticable. Whereas changes in accounting estimates are generally accounted for prospectively. Did you see the difference? Policy is being accounted for retrospectively, unless if it is impossible to make retrospective application. If that is the case, then we are going to adopt prospective application. Whereas change in accounting estimates are generally accounted for prospectively. That is 2 different things that this solution is trying to address. Now, circumstances of changes in accounting policy required by the standard. You tell them. If it's voluntary, you tell them. If it's required by the standard, the application should be treated based on the provision of that particular standard they are going to adopt. If there's no provision, then the changes should be accounted for retrospectively. If retrospective is not possible, the changes should be accounted for prospectively. Sorry, why is this still? So where there are no specific transitions, okay, I've explained this. We also have it in the notes. So difficulties in treatment of changes in accounting policy. Majority of difficulties are related to impracticability of applying changes retrospectively. This makes it difficult to achieve comparability of prior period with the current period. For instance, data may not be collected in the period to allow for retrospective application. Restating comparative information for prior period often require complex and detailed estimation. Yes, it's going to require a lot of time. The previous account you are preparing, you want to prepare using the new policy. It may not be that reasonable. It may not be certainty. It may not be certainly possible. You get, due to some unavailability of key financial information that will be needed. So the B part, the prior period and any manager, the term error. Prior period refer to an unintentional misstatement. You must make it clear, unintentional misstatement in financial reporting, including the omission of an amount or a disclosure. Correction is made by restating the comparative amount for the prior period presented in which the error occur. If the error occur before the earlier comparative period presented, the opening balance of the asset, liability, and equity for the earlier period should be reinstated to reflect the correction. IAS 8 require prior period error to be amended retrospectively by restating the comparatives as if the error had never occurred. So, any management specific income smoothing in form of creative accounting, which involve use of inappropriate provision. So, they are trying to explain what they mean by any management. Those it may appear that the factor associated with any correction could be linked to the any management. So they're not trying to tell us the meaning of the any management. So this answer look too bulky, but we can actually summarize it by making some little adjustment. But this answer speaks directly to what we are being asked. We have another question there with their solution. So it's something we can go through at our leisure time. So if there's any question, I think it's the right time for us to ask. Is after 10. Let me allow us to mute your mic. Please, if you have any question, please raise up your hand so that I can call you. Trying to allow us to mute your mic. So, Mr. Babatunde, please go for your question. Mr. Babatunde. Hello, good evening, Mr. Babatunde.
Good evening, sir. Good evening, sir.
Good evening, sir. Good evening.
Well, thank you so much for today's class. Please, I just want
Yes, sir.
to make a clarification on this error in the prior year. He said
Okay.
something similar happened in my work today, in the place of work today. So,
Okay. I don't know if I'm the only one. Your voice is some kind of breaking
already
somehow.
that's a transaction.
Hello,
But
sir.
in this one, we had to call that the same transaction that was having error on our application, because we used Oracle, now landed. That was last year, and now hit the account of the last year, which affected all the balances from that last year February to date of that particular account. So what we did now, based on this now, according to this IAS 8 now, we stated that if there's any error, we should use it to, we should take effect from the retained earning, balance brought forward. But what we did is we didn't consider the retained earning. Instead, we did something else. And based on what you said, and maybe when I get to office tomorrow, I will try to. But the question now is that you know that this thing happened in February 2024, and all the balances up to date changed. And if you want to go back to maybe an auditor comes and is trying to audit that particular account, and you now notice that okay, oh, in 2024 February, what we are having is different from the balance that we used to prepare the account. So that's the question I just want to ask. Hope there won't be any issue regarding to that. That's my question. Thank you.
So, thank you very much for that question. So, if auditors come to check your book and see the standard, the necessary um, the necessary standard you have with the organization, your DLs, each supporting document that speak to the figures you have. So if so far you have noticed that error yourself, so far you have noticed it yourself. So what is the I don't know how to ask this before I can be able to answer this question. What is the plan of the organization? What are you planning to do? Are you planning to correct these changes with the previous year retained earning, or you going back to that previous year and make the necessary change, do you think is it possible for you to go back and represent that? You know, we have it in the standard that if it become impracticable for you to go back and correct that mistake, then that particular error should be dealt with by correcting your by using your retained earning to pass the necessary adjustment. So is it that the company does not want to use the retained earning to correct the adjustment, or what do we have on ground? Hello, sir.
No, okay. I can hear you. You know what I'm saying is that that was the error that we committed. You know, instead of
Okay.
using it against the retained earning now, so we didn't. That's why I said it earlier that when I get to office tomorrow, so that we are going to revisit the issue by correcting it against the retained earning.
Okay, there won't be an issue if you
So that
correct it
when
with the retained earning. That is what the standards say. So one of the things we should know is that you should not see external auditor as a police that come to catch a thief. You are not a thief. I'm an accountant and I'm doing everything possible. I'm ensuring that all my postings, my activities is being done in line with the IFRS standard and provision. So if you make your correction based on the provision you have in the accounting standard, so if any external auditor comes in and you let them know that okay, there's error for and we detect this error in this year, so and we use our in line with IAS 8, we make use of our retained earning to correct our previous year's error. So there will never be any issue. That is what you've done. So, and if the auditor wants to argue with you, you let him realize that you make use of IAS 8. And I believe even the auditor should not argue with you if the auditor truly understands what the accounting standard says. Did you get?
okay, thank you, sir. Thank you, sir.
All right. So unless if the error are not immaterial, that is when you can ignore it, or you adjust the current period. But if the error is material, you should adjust it from the previous year within it. Thank you very much, sir. Madam Anushika.
Thank you.
Madam Anushika, you can go on. Madam Anushika, you can go on. Okay. Mr. Prudence. Mr. Prudence, please ask your question before we call it
Okay.
today.
All right. Good evening, sir.
Good evening.
Yeah, thank you for your input. I appreciate it. So my question is, when you come to retrospective application, right? How far backwards can one put it
So
into application?
as far back as it is possible. So that is why where the standard make it for us that in a situation whereby it's impossible for us to go back, we should start our prospective application. But if it's possible for us to go back, we should go back as far as possible. Did you get as
Okay.
far back? There is no specific period to our going back, but we should go back as
Okay.
far as possible for us.
Okay.
Yes,
That's all right. Thank you, sir.
you're welcome. So, Madam Ifunaya, I don't know if you are available to ask your question now. Madam Ifunaya, Mr. Abatu, do you have any other question? Because I can see you are still raising your hand up.
Sorry.
All
No,
right,
I
sir.
forgot to bring it down. Thank you.
All right, sir. Madam Ifunaya, are you available now? Okay, seems she's not available tonight. So I'm going to share these notes with us to our respective group chat once we are through with this class now. I'm going to share it with us. So please go through their questions. All these questions, they are past questions. Past question. And in addition to this, you can also just check through the question bank where they being analyzed year by year, where each standard is being is being tested. So you can check the year our this IAS 8 is being tested. You can check the structure of the questions. However, if we meet in our revision class, so we are going to test more of accounting, more of ICANN past question. Although we have some here already, we have some here in this note already. So I will share it with us in our class. So I think we can call it a day tonight. Or is there any
Hello,
other
sir.
one?
As the
Other
revision class
question?
started,
What do you
as
say?
the revision class started,
No, 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 no,
the
no.
revision class has started.
No, it has not.
Okay,
It
okay,
has not.
thank you.
They will inform you. They will inform you
Yes,
once
sir.
it starts.
I'm trying to join FM, but I couldn't.
FM. Okay. The reason is
Yes,
that
sir.
me, I don't have access to FM class, but I think okay, wait, hold on. Let me check. I think I saw the what's it called? The link that someone shared. Let me check. I want to check if I can share it to the group now.
Okay, sir.
I want to do
Sorry, please. I want to
German
see.
and the other
I saw. I saw the. I saw this. FM. Okay, I will. I don't know how I can find it again, but tax audit PMP serve.
Yeah.
Okay. I will ask the group admin for FM. Okay, okay, okay. I think I see someone there now. So don't worry. I will if you want to join the FM class, just message me after this class. Once I get the link, I will share it with you.
Okay, thank you, sir.
Yeah, no problem.
10 months.
Hello, sir. Will you drop the note after the class?
Yes, I will drop it. I will drop it immediately after this class. I will drop it. Mr. Abiodun, sir, do you have any question?
Yes, sir. Good evening, sir.
Good evening.
Thank you for the time. Sir,
You're welcome, sir.
on this
Retrospective
retrospective
application.
application of change, yes. I just want to say, when can we say it is impossible to go back, or what are those possible reasons for us to
Okay.
say?
Um, from my own understanding, when we are talking about changing accounting policy,
Okay.
Most, can you hear me?
I can hear you, sir.
So most companies believe it's a bit tiring for them to prepare their previous year financial statement due to the fact that they change one accounting policy or the other. You now go back to your previous year and represent your accounting transaction. So the possibility and the impossible part of it, it's, I believe it's an open clause to organization to determine if it's impossible for them to represent it, then they should start prospective application. That is the application from that day that that policy is being formulated till going forward.
Okay.
In a
Okay.
situation whereby it's possible, so the extent of possibility for that organization, they'll be the one to decide that no, it's possible for us. So to the extent of that possibility, they can represent their previous year accounting record too.
All right. Okay. Thank you, sir.
You're welcome. Madam Susan. Madam Susan,
Good evening, sir.
good evening, ma.
Sir, please, my question is based on the last class.
Okay.
And according to the question you taught us, you said if the non-correct asset do not meet up to two conditions, that it will not be classified.
It's not
I don't
even
know
two
if I'm getting
conditions. It's, I think the condition are like 5. And I said the
yes.
last one, when the asset, when the company were unable to sell that asset after a year. Is that the one we are talking
Yes,
about?
yes, sir.
So if the company are unable to sell that particular asset, you know, the asset should be reclassified as non-current asset held for sales for a year. Sales is expected to take place within 1 year. So in a situation whereby the company could not make that sales within 1 year, what is going to happen? There is 2 things. Number one, we need to look at, okay, why is that thing, why is that particular asset have not been sold within 1 year? Why have they been unable to sell it? What happened? We will now check if the reason of that inability to make that sales is something under the control of the company, is something within the power of the company. You know, it's possible now. Maybe you have one particular asset that you want to sold out, but within yourself, just feel like, I'm not sure if I want to sell this thing. You can have that feeling that I'm not sure, guy. So you just put it there for sales, but within yourself, you know that you are not sure if you want to sell it or not. If that is the case, if the organization have the control over the reason why that asset is not being sold, if the organization have control over it, then the organization is expected to reclassify the asset back to its normal class. Maybe it's IAS 16 or IAS 40. They should reclassify it back to its normal class. You know, when you want to sold an asset, you will reclassify it for that normal class to current asset. After reclassifying it to current asset, you stop depreciation. After you stop depreciation, you are going to call it current asset held for sales. After that, you represent it in a separate line under your current asset. All these things that you have done, the moment you are unable to sell it within 1 year, and the reason for that inability to make sales is as a result of conditions under your control, you are going to reclassify it back to the normal class that asset was before you bring it to current asset held for sales. Once you reclassify it back to the normal position, you will now calculate the depreciation that should have taken place. You know, you have stopped depreciation once you classify it as non-current asset held for sales. You have stopped depreciation. You will now need to go back and calculate that depreciation for that 1 year period. After you calculate it, you are going to depreciate that asset, impair it if possible, before you now get the present carrying value. Let me set an example for you. The value of asset is 10,000. You reclassify it as your current asset for sales last year. You know, you are expected to make sales between that last year to this year. Now, you are unable to make sales. And the results, the reason for that inability to make sales is something within the control of your power, that you are the one that decided that, okay, you don't want to sell it, no problem. Once it's this year that is complete that 1 year, you are going to reclassify that asset back to its normal position. Maybe it's PPE. You are going to put it back in PPE. You will now calculate that 1 year depreciation from that last year to this year. Maybe the depreciation value is 1,000. That means you are going to reduce that value of the asset from 10,000 to 9,000. You are going to recognize that 1 year depreciation. That is first leg. Now, option 2, the company is unable to sell the asset, but the reason for inability to sell it is out of their control. Why is it out of their control? It's possible that, okay, I have an asset. You have done everything possible. You have met up with all the necessary conditions, which include the company must be doing everything possible. There must be management consent. The asset must be in a sellable condition. All these conditions have been met, but still, the company could not find a buyer for that particular asset. If that is the reason why, the company have the right to continue to recognize that asset as non-current asset held for sales. As long as they meet up with all the conditions, they have the right to continue to recognize it, because the reason for inability to make sales of that particular asset is out of their control. I don't know if that answers your question.
Yes, sir. Thank you very much, sir.
You're welcome. So I'm going to share the notes with us. So, Oriade, who is Oriade?
Hello, good evening, sir.
Good evening, sir.
Good evening, everyone. Sir, my question was also based on that IFRS 5 we did last week.
Okay.
Yes, sir. What I wanted to know there is this, sir, is it that particular question that you have discussed with us, is it that we cannot measure it or something? Because based on the scenario, we have that some conditions has to be met, which is 5. Is it that do we have to wait till all the 5 is completed before we can measure, or there is a carrying amount of 20 million while the fair value is 25 million? Which one? I mean 28 million rather. So which one are we expected to do? Because I've tried to watch the video clip over and over so that I can actually get the outcome.
Firstly, what you are saying is 2 conditions. Number 1, there are 5 conditions that must be met before we can recognize an asset as non-current asset held for sales. There are 5 conditions. If you are given a standard account question, they may not necessarily give you all these 5 conditions. However, they will give you, if the organization has not been able to meet any of the conditions, they will let you know that, okay, this particular condition has not been met by the organization. So they will let you know that particular condition that the organization did not meet up with. They will let you know that one for sure. They may not list all the 5 conditions that organization have met all these 5. They mentioned 2, they mentioned 3. But if there is any condition that organization has not been met, they will let you know that, okay, the organization have not been able to meet up. They will let you know that this particular condition, the organization have not been able to meet up with it. They will let you know. Now, what value should a non-current asset for sales be recognized? What is the recognition? What is the carrying value of a non-current asset for sales? From our previous class, is there anyone that can remind us about that?
20 million naira.
So what is that 20 million? Is it a carrying value? Is it a fair value less cost to sales, or what? Is the lower of something?
Yes, is a carrying value from the question.
Okay, is the lower of carrying value?
Net realizable value.
Net realizable. Thank you. So I think the condition is that a non-current asset for sales should be recognized as, is it not current? Is it net realizable value or lower of carrying value and net realizable value?
Yes, lower.
Lower.
So that is the reason why we use that 20 something that you see that we use. So the value to recognize our IFRS 5 is lower of net realizable value and carrying value.
Okay, thank you so much, sir.
You are welcome, sir.
Right.
Sir. So thank you very much, everyone. Have a wonderful night rest with sweet dream. So I'm going to share this note to the class immediately. Thank you very much for listening to us this night. Really appreciate it.
Thank you so
Thank
much.
you.